Are you interested in investing, but don't know how to start? Today we're going to explore how to invest for beginners, what your first wealth-building assets should be, why they're ideal for you, and how you can start building your portfolio. Whether you're beginning with $100 or $10,000, this guide is designed to help you take your first confident steps. Saving is important, but over the long run, inflation eats away at the value of cash. Investing allows your money to grow faster than inflation by putting it to work in productive assets. Through the power of compound growth, your earnings generate more earnings over time. Of course, every investment carries risk, so the key is to choose wisely and diversify. According to experts, a practical roadmap to your wealth creation journey can be: A. Define your goals and timeline. B. Are you saving for retirement, a home, or just long-term wealth? C. Pick the right account type. A retirement account, like a 401k or IRA, offers tax advantages, while a regular brokerage account is flexible. D. Open and fund your account. Most brokers today have no or very low minimums. E. Choose your first assets. Focus on diversification and low cost. F. Stay consistent, automate contributions, and stick with it through market ups and downs. Now, let's dive into 5 of the most beginner-friendly and effective wealth-building assets you can start acquiring today. First up, index funds and ETFs. These are a low-cost way to invest in an entire market, such as the S&P 500, through a single fund. You get instantly diversified across hundreds of companies, and historically, they've offered strong returns over the long term. So, how do you start? Just open a brokerage account, search for well-known ETFs like Vanguard's VOO, or SPDR's SPLG, and buy shares. And hey, many brokers let you start with fractional shares, which is pretty cool for beginners. Next, let's talk about mutual funds and target date funds. These are professionally managed pools of stocks and bonds. Target date funds, in particular, automatically adjust risk as you get closer to retirement. They're perfect for beginners who want a set-it-and-forget-it option. Getting started is often as simple as enrolling in a 401k or IRA. Just pick a target date fund closest to your expected retirement year, and your allocation is managed for you, which honestly makes things a lot easier. Alright, so, let's talk about individual stocks and dividend stocks. You can actually pick shares of specific companies, and dividend stocks pay you regular income. There's the potential for higher returns, plus you get that sense of ownership in businesses you really believe in. Another thing is, dividend stocks also provide solid cash flow. If you're wondering how to start, begin small. Maybe allocate no more than 5 to 10% of your portfolio. Use a broker's stock screener. Focus on stable companies, and reinvest those dividends for faster compounding. Next up, bonds and bond funds. In simple terms, these are loans to governments or corporations in exchange for interest payments. Bonds are generally more stable than stocks. They act as a safety net during market downturns, and, yeah, they provide predictable income. If you're just getting started, instead of picking individual bonds, beginners can buy a total bond market ETF or mutual fund, which spreads risk across many issuers. Okay, so, finally, let's talk about real estate investment trusts, or REITs. These are companies that actually own and operate income-producing real estate, like apartments, shopping centers, or office buildings. By law, they have to pay out most of their profits as dividends, which is pretty cool. REITs give you exposure to real estate without needing to buy physical property yourself. They add diversification to your portfolio and can provide a steady income stream. If you want to get started, you can look for REIT ETFs or mutual funds in your brokerage account, like say Vanguard's VNQ. You can also buy individual REIT stocks if you prefer. And the nice thing is, these can be held in both retirement and regular brokerage accounts. So, let's imagine you're 30 years old, just starting out with $1,000, and you're willing to contribute $100 each month. A beginner-friendly mix might look something like this: 50% in a US stock index fund, 20% in a total bond fund, 15% in a REIT ETF for real estate exposure, 10% in international stock index funds, and 5% in dividend-paying individual stocks. This kind of portfolio balances growth, stability, and income, while still being simple enough to manage. Alright, Here's a simple action plan. First, pick a broker. Look for one with no trading fees, low account minimums, and some good beginner tools. Next, automate your contributions by setting up monthly deposits to your investment account. Then, use dollar cost averaging. By investing regularly, you'll buy more when prices are low and less when they're high, which helps smooth out risk. Remember to rebalance yearly. Just adjust back to your target percentages once a year. And most importantly, stay disciplined. Don't panic if the market takes a dip. History shows that markets recover and grow over time. In conclusion, to build wealth, you really don't need to chase complex strategies or try to time the market. Just stick with proven assets, index funds or ETFs for broad growth, mutual or target date funds for simplicity, individual and dividend stocks for ownership and income, bonds for stability, and REITs for real estate exposure and steady dividends. By starting small, automating your contributions, and staying committed, you'll harness the power of compounding and put yourself on the path toward long-term financial freedom. So, before you leave, in which asset class were you interested the most? Let me know in the comments down below.